Are you really confused these days, wondering, is the stock market going to keep going up? Or are we due for some kind of a correction, if not a complete turnaround that results in a complete crash? Well, if this is something that concerns you, and if you're any investor, it probably should, stay tuned. I have something that I'd like to show you. It seems like we get a lot of different news these days. There are people that naturally, when the market goes up, there can be a case to say that the market is going to keep going up. There are also people that are continuously down on what's happening in the US economy, and they keep saying we're going to have a crash, things are going to really go crazy, and life is never going to be the same as we know it now. Well, depending on who you are, if you keep saying the same thing over and over, eventually you will be right. That doesn't really help us as we're trying to make decisions each day. What I do is I look at what's really going on. I pay attention to the good and the bad, and I just take it for what it is, because the different types of strategies that I use can take advantage of any kind of market climate. But if you're concerned about what is going on in the stock market right now and why does it keep going up, I think I might have some answers for you. What I'd like to show you is a thing called the PE ratio. Now, a lot of you that are investors, you probably already know what that is. It's the price of the stock based on the earnings. Now, what we use is a thing called GAAP, and I go into this a lot more specifically and in more detail in my classes, but I just want to give you a very brief overview right now, where we look at the trailing 12 months, TTM, and what we can do is then investors will then multiply that number by 10 or 15 or 20. Now, if we multiply that by 10, then we have what is considered to be a cheap stock market, or that stock is considered to be cheap. If we multiply it by 15, that is considered to be fair value. That's a pretty good price. It's not too expensive and it's not too cheap. However, when we multiply that number by 20, we get a multiple that's really pretty high. And once we start to go above that, stocks are considered to be expensive at that point. And that's when you want to be careful. Now, does that mean you have to be careful right now? Not necessarily. This is a situation that can go on for a long time. Stocks can be overvalued or undervalued for a considerable length of time, meaning months, weeks, not really years, but at least a longer period of time, so you don't have to just make your decision right now. What I want to do is show you something that you can keep your eye on, and then when you get to the point where you're feeling uncomfortable, some changes may need to be made at that point. So I'm going to switch over to my screen and show you a picture of what I have here. What you see in front of you is the closing value of the S&P 500. Not only can we have a PE ratio for every stock, we can take all of the stocks that make up an index, put them together, and come up with a PE ratio for the index itself. A lot of times you might use this when you're comparing a stock with an index to see if it's overvalued or undervalued or at fair value compared to something bigger. It's like, what's a big number? Well, you use this to get more insight as to, relative to the market, is this stock expensive, cheap, or at a pretty fair price? But looking at this, what you see right here are three different calculations. There's on the very bottom, there's the green dotted line, and that's if we took the current multiple of the S&P 500 by 10. And that just shows you what the value of the S&P should be if we just multiplied the earnings of all the S&P 500 companies by 10. We should be at about 1,000 right now. Okay, the last time that this chart was updated, we were at, almost at 4,000 with the S&P 500. We're at 3,900 right now. We're just under that. So the stock market is certainly not cheap right now. At least the S&P 500 is not cheap. Then we go up to this next line, which is blue, and that would be considered fair value. We multiply that by 15. And over the course of history, a multiple of 15 has usually been pretty good, meaning safe. You're not really overvalued, you're not undervalued at that point. Well, if we looked at this and multiplied it by 15, the S&P should be just under 1,500 right now. Remember, it's at 3,900. And now, what we can also look at is this dotted red line, where if you look at this, you notice that we should be just under 2,000 with the S&P 500 right now. Well, we're not. We're at 3,900, over 3,900 as I record this. Now, do you see where the S&P is, and then compared to this red, blue, and green line? Does that give you any concern? Maybe yes, maybe no. Well, let's look back a little bit and see what happened. If I go all the way back over to 1980, that's as far back as this chart goes, you can see that there were periods of time when the stock market was considered to be cheap, other times when it was more at fair value, and then at other times when it got above the red line where it was considered expensive. If you see where I have the mouse right now, that's the 1987 crash right there. And some of you were around to actually experience that, and it was a very painful day. But stocks, they needed to adjust, and so they came back down to, after that crash was over, at least according to the S&P 500, they were back at fair value. And then the market started to recover, and we stayed at fair value for a couple of years, in 3-4 years. And then as we saw the 90s come around and the dot-com tech boom and bust happen, you started to see things get out of line, where we were shooting up and we went way, way above the red line. And that was at the point where if you just took your money and threw it towards the market, it would double in 3 months. And it just seems like everybody was crazy at that point. Any .com was good. Well, the party ended, and as what has to happen, there weren't earnings behind those companies, because that's ultimately how a company stays in business. They have to make money, and then they have to make profits on the money that they bring in. So we saw things go down and get closer again, more of a fair value at that point. But then 9/11 happened, and that just decimated the economy for a few years after that. But we were still pretty expensive at that point. Then we came back up out of that. We started to recover, and things were looking pretty good into 2005, 2006, 2007. 2007 was a pretty good year for the market. Well, those of you that have been around a little while know that we had a major meltdown in 2008, and everything just tanked at that point. This number had become unjustified at that point, and this actually dropped down. All of the earnings dropped down. The S&P actually turned negative at that point. That's why some of the charts look a little strange. But then after a few years of that, things started to recover, and we saw kind of a nice bounce up where we were at fair value for a while and then started to climb. Then you get into 2016 and the election and all the turmoil that caused, where we saw things really go up. We saw earnings go up as well, but we were still pretty expensive at that point. And we saw some pullbacks, and I remember right here where I have the mouse, I remember talking to somebody at this point and saying, we're way far away from this line right now. Something needs to happen to bring this back in line. Either earnings have to go up or this black line has to come down. And within a couple of days after that, boom, we had the major COVID-19 breakout, which just threw the whole economy into turmoil. And that's where we're at right now. We're still trying to figure out, where do we go from here with the economy? Well, as you've had all this stimulus added to the markets, and a lot of that finds itself in the stock market, we've seen prices really shoot up. Well, we've also seen earnings really shoot down. And so right now you can see there's a real strong disconnect between where the S&P is and where the S&P should be at this point. Now, does this mean you freak out right now? Probably not. But does it mean you might want to keep a closer tab on things? That's where I would come out. Because I've been watching this for a while, even before I recorded this video, and this has been a concern of mine. And I'll do updates to this video. This is first quarter 2021, about halfway through the quarter as I record this. And I'll do another video as the need dictates. But you can see that we're really far apart. Just to give you another example, I have another chart where it's the same chart on the top where we have the red, blue, and green, and then the current value of the S&P 500. Well, down below, I just did a real simple calculation where you take the value of the S&P 500 and subtract the red line. I didn't even worry about the green or the blue line yet. I'm just subtracting it from the red line. And this might make a little more sense. Do you see how far out of line we are? Now, there's a lot of changes going on in economic policy and fiscal policy, not only in the US, but all around the world. Things are getting reset, if you've heard that word. Whether that's going to be positive or negative, we just have to watch it play out. But we need to react because we have investments in the market that we need to keep an eye on. So this, if you look at it historically, yeah, this is a real concern. But the market isn't really reacting to this right now. We'll just have to see this unfold as the stimulus that they keep throwing into the market, as that starts to go away, our company is going to come back and start boosting these earnings higher again. So just be aware of that. And if you have any comments, please feel free to subscribe to my channel. If you want to leave a message about this video, feel free to do that. And if you also want to take a free workshop that I've recorded, look in the link right below you and you'll have access to that.